Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
Danielle, any thoughts on the federal election and what that might do to our finances personally?
I like the fact that there was no majority. I think it's good for minority governments to have to work in coalition because there's a lot of complex issues at hand right now, and frankly, none of them had a platform that deserved carte blanche, in my opinion. So, I think the overall trend going forward is going to get harder for them to manage because we're heading into a slowdown in the economy. So the revenue side is going to take a pinch just as the benefit side starts increasing in terms of, having to pay out unemployment benefits and things. So I think the balanced budget idea is off the table for a considerable period of time here. And I'm just hoping that fiscally we get our act in order because we need to do things to really revolutionize some of our status quo systems and infrastructure. And there's some really incredible growth opportunities there. A lot of other countries and municipalities and states, even in the federal government, even though the federal government in the U.S. is anti-climate stuff, you don't need to be pro-climate stuff to see the business case in some of this infrastructure build-out. It's really quite incredible. You see places like Florida, which is, very conservative Trump country, and they've just announced they're building the world's largest battery to hook into an existing, 500-acre solar panel farm they have there. There's, whether you're in California, whether you're in Europe, whether you're in the U.S., everywhere right now, China is seeing enormous reason to build out infrastructure, primarily wind, solar, and battery storage, because there's just such a huge opportunity there to lower costs. So, once you get the upfront costs, which first of all are much lower than trying to build a nuclear power plant or gas peaker plants or any of that stuff, once you've got the initial wind, solar, and battery installation in place, your capital cost gets paid back and you've nearly got a zero marginal cost after that, which, is extremely attractive in a world that's looking for, higher cash flow to spend on other things. So we really, I think, need to focus on all that. So I'm hoping that the coalition, the divergent views will, hopefully bring them towards more productive policies than just how do we get housing prices up higher and make them more affordable and how do we get more consumer debt into the household. Those plans have been the go-to for about a decade, and they're really counterproductive.
California, Quebec had a cap and trade agreement to deal with carbon emissions, and the Trump administration now said that's illegal because they're dealing with a foreign government. Is this going to be a setback for people trying to balance carbon emissions?
Well, it's a very new area, so this is obviously nothing, is easy to figure out here, but the overall impact is that the cost of carbon is definitely a cost of doing business, and it's definitely going to continue to be priced. And right now, even the pricing that's in place is a fraction of what it should be. And people can hate that or whatever. It doesn't matter. It's math. It's just pure, the full cost of the technology involved versus another technology which has less of a carbon cost, pollution cost, all that. In terms of that structure, if we don't increase the carbon tax on the heavy emitting industries, then the rest of the economy is essentially going to have to contract completely. So it's obviously completely unsustainable that way. It's interesting. I noticed there's a new report out of Citibank in the U.S. this week, which is calling attention to the fact that the airlines. So there's an example. The whole the cheap seats that have come up in the last decade. The traffic or the amount of users on air travel has literally doubled in the last decade, which is remarkable when you think about it. The population certainly hasn't doubled, but the air traffic has. The reason for that is, frankly, because of cheap money, too much debt, too much financing, too much ability for both the airline companies to borrow and spend and build out their fleet, as well as for consumers to access debt and buy seats. And so you've had a huge growth in that capacity. But ultimately, it's not priced properly because the impact that it's leaving, both in cost of carbon and emissions of all kinds, is huge. So if we start forcing, and this is going to be essential because it's a finite closed system. So when we start increasing the amount, and that's happening, it's already happening, for example, in tankers, where new emission standards are coming in, and all of a sudden the cost of the ships has gone up dramatically. That's going to continue, and it's going to happen for the airlines. They're going to have to bring in a mandatory, for example, carbon offset program, where either they make the passengers purchase it, which some people already do voluntarily right now. I do. But if you go on to do the purchase right now, you could pay $30, for example, $30 a ton. And that's, way below market. Market should be more than $100 a ton. So once those costs start coming into it, it makes people make more sober decisions about where and how they're spending their time and money. And also for investment purposes, it helps industries understand that old technology is no longer profitable or viable if they have to absorb the full cost accounting of their activities. And so you're going to see a whole reshuffling in that industry because either, the airlines, for example, are going to absorb the cost, which is going to make them less profitable, and they're already a thin margin business, or they're going to have to increase the cost. And if they increase the cost per seat, of course, they're going to see a decline in the amount of users, which is appropriate, which is what has to happen to make this thing balance again. But again, it's going to put intense financial pressure on this highly leveraged, thin margin sector. And so, there was the city's story was that the flight shaming, that was, for example, highlighted by the young Swedish activist Greta not taking the plane to come to North America. But it's top of mind for many people right now. It's not just, an activist but it really sort of highlighted it. And it just shows you the headwinds that are coming for these antiquated technologies in this new economic model, which has a full cost accounting aspect to it. So it's exciting because there are so many great ideas and developments already afoot, as I said. And yes, we probably don't have battery storage capacity yet to work for big jet engines and tankers, but we have, hydrogen fuel cells, which are a stopgap that can be used in that technology until we do get the batteries that are probably going to be able to do it eventually in the future. Right now, they're, the Nobel Peace Prize winning 3 guys that got the Nobel Peace Prize in chemistry this month were the original inventors of the
lithium-ion battery.
Yes, thank you, the lithium-ion battery. So they've been working on it since the 70s, right? And they are now also working on a solid-state battery, which John Goodenough, one of the recipients of the prize, has worked on. And it does things like, increase the capacity or the density of the battery by 70% over the lithium-ion battery. Meanwhile, the costs of these things have come down by 80% in the last 10 years. So when you've got this kind of technological revolution going on in energy, in equipment, transportation, all these factors which are so fundamental, it really does shift the dynamics very quickly. And that's why I put on the clip about the third industrial revolution, which is Jeremy Rifkin's work. He's been advising China and Europe and many countries on energy innovation for 20 years already. Europe's way ahead in terms of their rollout. because, primarily because unlike North America, they aren't a major fossil fuel producer, so they haven't had the sort of, blinders on, where their livelihoods were connected so much to that one sector, and they've been able to be more proactive, and they've been focused more on how do we reduce our costs, because they were having to buy so much of their fuel. And so from an economic perspective, you don't have to believe in climate change or any of that to see that this is a smart thing to do, right? So the technology is amazing. There's an island they're building in the North Sea right now that's being partnered with Germany, Denmark, and the Netherlands, and it's basically a 2-mile island that they're going to put something like 700 wind turbines on, and it'll power an estimated 80 million European households. So just stuff like that, and here's the thing that people have to get their head around, and Mr. Rifkin talks about a lot, is this marginal cost. So once you repay the capital cost, you have to invest clearly to build out, whether it's a wind farm, solar farm, the storage capacity, which we didn't have 10 years ago. We really didn't have the storage ability. So there was, you could produce this intermittent power, but it was really hard to retain it and use it efficiently and balance out the grid. Well, now with all the evolution of battery technology, and not just batteries, there's many other storage facilities which have been used for centuries, that actually make sense in this context. And that means that suddenly you can build out these new systems and then get to a point where you're basically at a zero cost per joule of energy after you've repaid your capital cost. And you never get there with things like fossil fuels, where you're continually having to, drill new wells and pump and get pipelines and infrastructure and build and then pay carbon emissions taxes, and all that part is just can't compete with this other system. And indeed, Rifkin points out that what he calls the third industrial revolution, which is now, is the one built on the digital neural network of the internet. It's been going on for the last 20 years, but essentially the internet and the leaps and bounds that have happened in semiconductors and connectivity allows such, and now building out the energy grid, and building out the, autonomous transportation capacity. All these three things are the backbone of this third industrial revolution, and it's all about efficiency. So this is quite a challenge to conventional views, which are premised on how do we get costs higher, how do we increase price, and how do we increase GDP every year. In this model, it's more about how do we cut out waste, how do we bring costs down, how do we get this marginal cost to be, basically free energy going forward, because that's a friction cost ultimately, right? It's like a tax on every enterprise, every household. And if you don't need to pay it, then why in the world would you, right? And we can't afford to pay it in a world where we have so much need for capital for health and all these other food production, water management, all these important fundamental things. So it's an extremely exciting time, and a lot of people are understanding that. I mean, Alberta is getting a massive influx of solar investment. It's because it's starting to move away from, the oil investment is starting to move out of the province. It's more, there's a story that Exxon is one of the last big proponents in the oil sands there. And I don't know if you noticed this week, but there was a lawsuit, Jim. The New York Attorney General is suing Exxon because it kept two sets of books. And here's the clincher. Here's why I think this is a significant development. It's not suing it for harming the environment, Jim. It's suing it because it says that it misled investors with underestimating the full cost of the impact, and thereby going into projects which were actually malinvestment and not sufficient return, but they justified it by underestimating the cost. And so that, I think, is something that's going to have traction, because it's this group of shareholders who are saying, hey, you had a fiduciary duty to us, and you misled us and made bad investments, which may indeed be now sunk costs and stranded assets, and, our return on investment has been brutal. Those are the things, I think, which are really getting the investment publics or the investment community's attention. And that means that there'll be less funds available for that sector and more funds flowing into some of these other higher growth areas.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Danielle Park. Danielle, companies right now are laying off people, saying they expect an economic slowdown. Well, if they're all starting to lay off people, isn't that going to be the cause of the recession?
Well, it's more of a symptom, Jim. It's there's a lot of moving pieces to the cycle, but essentially once the credit cycle turns down in the world, which it did a couple of years ago, you start to see a decline in spending, a decline in consumption. And we're seeing that. For example, China's latest GDP number came out at 6%, and it's projected they're going to fall below 6% in 2020. So they've been, the high growth economy of the past decade, and they're now in a downturn as well, not because they lost their population suddenly, but because this consumption trend has turned. They have immense debt and a lot of bubbles and too expensive housing, which makes no sense relative to income in the country. And those typical things are sluggish things that slow, productivity stagnates, and you really get no good growth, so to speak. So you see that, but you see it also in North America and Europe and all over the place. CEO confidence, which is often correlated with when CEO confidence falls and bottoms out, it's typically a sign that you're going to see some layoffs in the near future after that. The CFOs, almost more importantly, who are the number crunchers in companies, they are projecting that there will be a recession. Most of them are saying they will see a recession within the next year, so they're now looking at how do we pull in spending, cut costs, and yes, reduce the labor force. So that coming from a time when initial jobless claims have been at all-time lows, reported or official employment has been at an all-time high. That's highly cyclical. Although, yes, this has been a very extended cycle, when you see that sort of CEO confidence bottoming out as you have in the last year, CFOs predicting recession and looking for job cuts, it's very common to see a spike then in unemployment. And then, the dominoes go from there because we've got a very indebted population, as you well know. They generally don't have very much savings cushion to fall back on, so consumption is directly hit when certainly discretionary consumption is remarkably hit when you get into a period of rising unemployment. So all that is important in terms of, the perpetuating the downturn. But it's not as simple as, I wish someone wouldn't say that they're feeling like there's a recession coming, or, I wish people wouldn't talk about layoffs. I mean, I say you have to go into this stuff with your eyes wide open, because otherwise you're sort of stumbling through, sleepwalking into a nightmare, I call it. So, it's better to be prepared and be aware, and that means during the boom time, as we've discussed many times, pay down the debt, build up the savings, try not and spend more than you earn, live beneath your means, so to speak. Try and diversify your income streams. Try not and have your savings once amassed in very dangerous assets, which the world is full of right now. It's ironic that Goldman Sachs points out in a report this week that, the vampire squid, good old Goldman Sachs, they point out that S&P earnings forecasts are negative. We're in an earnings recession, but also that the yields on the S&P companies or the S&P investments, the median yields, are just over 2% because price is so high. Now, what do they do? What do they suggest that people do? Because of that, they say, well, then, try and find things with dividends of 3%, because that'll pay you more while you hold these assets. But what no one mentions is that for that incremental benefit, perhaps of 1% more than you could get in a safe deposit or a GIC, you can actually lose half or more of your principal. And going into these downturns from highly levered, highly overvalued periods, after one of the longest expansions in history, what you have is a cocktail for greater than average losses in stocks and corporate debt. And so again, this is part of the self-preservation sort of approach that you have to take, is to realize that places like Goldman Sachs and the banks and all of the, financial sales franchises out there are in the business of getting you to hold their products so they can collect their fees. So when they start talking about, how growth rates are low and recessions are coming and people are feeling very bearish and there's lots of, capital risk, they also go on to say, so what you should do is hold dividend stocks. And what I would say to people is realize that's them talking their business model, and don't do what they say, listen to what they're saying in terms of the overall risk climate for assets. And so that means that you have to keep your savings liquid, do the opposite of the crowd, try and resist that temptation. Frankly, for an extra % of yield, I don't think it's that much of a temptation. But just to, keep your fiscal health as strong as you can, so that you have opportunity on the other side of the downturn.
We'll have more with Danielle Park right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, Tesla turned a surprising profit in the third quarter. Is that good news for the electric car maker, and maybe good news for people who are thinking about selling more electric cars?
Yeah, well, it's a huge trend in the world right now. Tesla's definitely the leader, as we've talked to before. It has done that with a lot of financial risk because they've accomplished the impossible. They've had to borrow a ton of money in order to build out the infrastructure. I always say, let's not forget that the legacy automakers went bankrupt in 2008. That wasn't the first time they'd been bankrupt, and they'd had more than a 100-year start on Tesla, right? So this is a very difficult, hot, capital-intensive industry to be in, and yet Tesla has so far managed to not only survive but thrive, rolling out world-class vehicles that everyone is now trying to emulate. Their upside is their production's going better than they'd hoped, and the China rollout's going well, and they hope to have their new sedan or SUV style Y out by next summer, which are all trends in the right direction. What I think is good for average people is, first of all, two things. One, it makes a greater pool of, every year that Tesla keeps going and making cars, it creates a greater pool of used vehicles available on the market, which people can then buy at a good discount. And don't forget, these are vehicles that are likely to go, up to 1 million miles in terms of duration. This is not your average, junk it in 3 years type of vehicle. So again, if you look at this whole business about getting your marginal cost to zero, once you can buy the vehicle, pay for it, thereafter your costs of running are almost nil, very, very low. Your fueling costs are whatever, if you're, $2 or $3 to charge it from full if you do it in the off-peak hours, and very few parts, very little running, maintenance, etc. So you can literally get transportation for almost free after you've paid for it up front. That's never something you're going to get with an ICE vehicle, right? So this is all very promising. At the same time, you had Volvo announce last week they're rolling out a whole new line of electric vehicles. Let's not forget that the batteries in these cars as well, back to John Goodenough and the, lithium-ion battery stuff, batteries have come down 80% in the last decade in terms of cost. So all the people that said this was impossible and, batteries were prohibitive and all that, they were talking about math that is no more. And so every year, with all the people, all the backyard chemists, everybody working on this project, it's like a moonshot, right, of how do we get this storage for all this free energy that is coming onto the earth every day through wind and solar. How can we store it and make it so that it's, available? And so this battery push is really global, and its the benefactors are the EVs, which are, forecast to be 40% of global sales by 2030. Already, what's interesting, we're heading into a new year and it's 2020 and it's kind of surreal, right, Jim? Because you can remember the 60s, 70s, 80s, 90s, and now we're heading into the 2020s. But what I find remarkable is that all of the things I've been reading and following the technical iterations that have been coming out in the past, decade or more have all been sort of heading towards, and it seemed to be forecast that would be possible by 2020 and 2023. Well, now this is just around the corner, right? So the dynamics and the math of it is really appealing and compelling now, which is a very exciting thing to see.
I'm still looking forward to the flying cars.
I'm not sure. I prefer to stay on the ground if I can, but hey, if they're efficient and better overall, I'll have a look at them.
I just remember the front cover of Mechanics Illustrated in 1967, Flying Cars by year 2000. And
well, they missed that slightly, eh?
Well, but it's true. When you see how people drive on the ground, you really wouldn't want them in the sky. Danielle, thank you so much for chatting with us.
Hey, thank you.
My guest has been Danielle Park, editor of the blog Juggling Dynamite. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.